Hello and welcome to the latest edition of Market Sunrise. We've got another packed show for you this morning. The question of the day is, will President Trump's big beautiful bill get passed before the July 4th holiday? Well, also coming up in today's show, we'll take a look ahead to the US unemployment report and how the tears of a finance minister moved the market. Stick around too to hear more from our exclusive interview with the Secretary General of the OECD. I asked him whether AI would take away our jobs. So grab that coffee and let's own the morning. So let's take a look at the things you need to know before the opening bell rings on Wall Street. We begin with President Trump's big, beautiful bill. House Republicans overcame a critical procedural hurdle to advance Donald Trump's massive tax and spending package early this Thursday. In fact, they held a key vote open for hours past midnight as the president and his allies worked hard to win them over. The House voted 219 to 213 to effectively move the bill towards its final vote. Now, the bill includes tax cuts that Republicans campaigned on, a phase-out of clean energy incentives that were brought in under President Biden's administration, and also funding for the president's immigration policy. A key issue was the cost. It's estimated that it will add at least $3.4 trillion to national debt over the coming years. Now, all this bodes well for the bill to be passed before tomorrow, which is when the president wanted it all to be wrapped up by, though he was clearly frustrated in some of the delays and vented so on Truth Social, of course. Now, the second thing to know before the bell is China's reaction to the trade deal the US has struck with Vietnam. Now, just to recap, the deal with Vietnam lowers tariffs on Hanoi's exports from a threatened 46% to 20%, but retains a 40% levy on what's called transshipping of goods. That part is important as it is seen to be aimed at Chinese re-exports to the US. Now, China's Commerce Ministry said today that they firmly oppose any party striking a deal at the expense of China's interests. Now, Vietnam is one of the most trade-dependent countries in the world, and 30% of its exports end up in America. Now, shares of retailers like Lululemon, who've had let's face it, a pretty terrible 2025 when it comes to share performance so far, bounced on the news. It's thought around 40% of all of Lululemon's goods are made in Vietnam. Now, this latest trade deal now shifts the focus on whether India might be next. Now, the big stumbling block there will be India's agricultural sector. The US wants more access to it, but India has refused to budge against lowering tariffs on genetically modified corn, soybeans, rice and wheat grown in the US. And finally, the big thing to really know about is the jobs report. It's expected to show hiring slowed, while the unemployment rate moved higher last month. Investors will be looking out closely to watch for any further signs of slowing in the US labour market. It comes just after the S&P hit a record high. So just how will the markets react to this pivotal report? Well, let's take a look, as that's our chart of the day.
It's time now for our chart of the day, and we're looking at expected moves in the market on Jobs Day. Projections from JP Morgan show the S&P 500 rising in most scenarios around the jobs report. So let's break this down, because you can see here, if we get 145,000 or more jobs, they're forecasting a probability, a 5% probability of a 1% to 1.5% gain. That's in the S&P 500. Now, if we saw between 125,000 to 145,000 jobs, there is a 25% chance of up to 1.25% gain for the S&P 500. Now, the data showing a gain for the S&P 500, so long as jobs come up above 105,000, below that, we are looking at slight declines here. So there you're taking a look at some of the probabilities of this playing out and then the expected move. And here's what's also on investors' minds, especially as they're weighing through a myriad of different data prints on the jobs and employment situation front over the course of this week, as we had already gotten jolts out earlier today. And we're still going to get ADP private payrolls. The larger question going forward for the employment situation is, are there enough areas to signal to the Fed that there is severe weakness that forces them to act prior to September? The market's still looking for about 50 basis points of cuts going into the end of the year. And with that set to kick off in September based on some of the analysis and probability on the CME Fed Watch, well, that would mean that they would need to lock in a trend over these next few reports, and going into their July meeting, they would have to change that tenor a little bit more aggressively, perhaps.
And for our trending tickers today, we have a bit of a special edition. We're going to be focusing on semiconductors. Now, we're seeing a lot of action in markets overnight after the US lifted some curbs on the exports of chip designs to China. That's linked to a recent trade agreement between the world's two largest economies. And the companies that are global leaders in chip design have confirmed they were notified by the US Commerce Department that they could effectively resume business with China again. Well, that got investors excited from the US to Europe to Asia. So let's look at how that's reflected in three key stocks. Well, our first ticker is Cadence Design Systems. It was up more than, 6%. It's now just below 6, up just over 5.8% in pre-market trading there. Another big American chip designer, Synopsys, also saw similar gains. And both companies confirmed that they are now in the process of restoring access to their restricted tools for clients in China. Now, for the second trending ticker, we head to Germany with Siemens, a stock that's been performing particularly well in the past 3 months. And this news of the easing curbs is giving it an additional boost. Now, it's currently up more than, let's have a look at the chart now, up more than 2% in pre-market trading already. And now, company spokesman said Siemens has restored full access to software and tech under previous export rules and has resumed sales to Chinese customers. Stock there up 1.2% in pre-market. And finally, even this one is not a chip designer per se, but let's look at how TSMC is doing. It's the world's largest chip manufacturer, and it saw its US listed shares rise around 4% on Wednesday, just below 4% there, after its price target was raised by analysts. TSMC is getting confidence from investors, also following reports that Intel was scrapping plans to step up its efforts to challenge TSMC in manufacturing certain types of super advanced chips. Now, just a note of caution here on the US-China relationship. The trade truce between the US and China expires in August, and tariffs right now are still extremely high, and both countries have made it clear that there are still quite a few differences that need to be ironed out before they can put in place a long-term framework for trade. Chips are a highly strategic and competitive area, so it wouldn't be surprising to see further changes in this field. Now, these were our trending tickers this morning. As you can tell, there's a lot to look out for today. Outside of the chip-making world, keep an eye out on stocks like Datadog, Oracle, Rigetti Computing, and Watches of Switzerland. They're all particularly active right now. Now, there's a lot of tech that's moving markets this morning, as I've said. So is it going to power, and this tech is going to power the next wave of AI? But what does that mean for our jobs? Well, that's what I asked the Secretary General of the OECD, Matthias Cormann, in my exclusive interview.
The upside opportunities and benefits are incredibly exciting across a broad cross-section of activities. I mean, whether it goes to access to higher quality healthcare, education, being able to manage our energy production consumption better, and indeed productivity improvements could be quite extraordinary and help drive stronger growth and ultimately higher incomes and living standards for people around the world. But there are a whole range of challenges and risks to be managed and to be dealt with. And one of them being that AI, while it's developing very rapidly. It is developing very rapidly in a comparatively concentrated way. I mean, sort of the diffusion of AI as a technology and the opportunities that come with it are not yet as widespread as they could be and should be in order to really optimize the benefit for people. And so what we're really saying is that we need to look at AI like a general purpose technology where it's important to facilitate universal access, where it's important that we ensure that the workforce is equipped with the skills in order to be able to participate and benefit in all the opportunities, and where indeed we protect the appropriate levels of competitive tensions in the system, that this doesn't become a technology that enables the big companies to further lock in a market dominant position at the expense of smaller players and competition and the innovation and productivity improvements that come with that. So there's a broad range of issues that will need to be addressed in order to ensure that all of the exciting benefits for humanity can indeed be unlocked.
Are you not worried that perhaps artificial intelligence could take away jobs, could move, people into less well-paid jobs because they're being replaced by AI?
Well, I mean, the data is not showing that it is pushing people in less well-paid jobs. It's certainly true that it will transform the labor market, and that there is a whole range of jobs that will either change or disappear, and other jobs will be created that will respond to the needs of communities and economies around the world in a different way. I mean, that's always been the case with innovation. Whatever the innovation has been in the past for hundreds of years. Some jobs disappear and new jobs are created, and we do things differently, but it doesn't mean that there will be fewer jobs. It just means that the jobs will be different. And if we look at the labor markets around the world right now, I mean, if anything, there's a great level of tightness in labor markets, and we are looking at skilled labor shortages in key markets around the world. And so really what we need to do is ensure that labor markets and people, workers, are equipped with the necessary skills to be able to really take advantage of all of the opportunities.
Interesting stuff there from Matthias Cormann, the Secretary General of the OECD, speaking to me in an exclusive interview here on Yahoo Finance. And particularly interesting that he's so positive about AI, but note that's only if countries work together to actually ensure that our job security is sort of ensured as well. Coming up after the break, we'll be looking at how the tears of a finance minister moved markets, and also, of course, another look ahead at that jobs report, that crucial jobs report coming out in just over an hour's time. So stay with us for more on Market Sunrise. Welcome back. Well, let's take a look at what's moving markets today. Well, the tears of the UK's finance minister made quite the impression on the gilt markets. Those are British government bonds. Now, if you haven't seen it, take a look at this.
The reason why he can't answer the question is because he knows it doesn't save any money, it's going to cost millions. This is the first Prime Minister in history to propose a bill to save money who ended up with a bill which costs money.
I'm really proud, Mr. Speaker, that in the first year of a Labour government we got free school meals, breakfast clubs, childcare, got £15 billion invested in transport in the North and the Midlands. With cutting regulation, planning and infrastructure is pounding for.
Well, British government bonds tumbled sharply on Wednesday after that tearful appearance by Rachel Reeves in Parliament. She was attending Prime Minister's questions following the government's decision to sharply scale back plans to cut benefits. The sharp plunge in bond prices quickly brought back memories of when Liz Truss's short-lived term as Prime Minister was brought to a crashing halt after a huge gilt sell-off. This time, the yield on the 10-year government bond rose as much as 22 basis points to hit 4.681% at one point. It did recover slightly. Now, remember, during the depths of the 2022 crisis under Truss, the yield on the 10-year gilt actually rose by 50 basis points in a single day at one point. Now, that's more than double what we're seeing right now. But it seems clear that bond investors around the world are growing more and more nervous about government deficits, from Japan to the US, as we've highlighted many times on Yahoo Finance. But Britain is seen as one of the most vulnerable in this regard. If it wasn't just the tears that caused the sell-off, though, that intensified after comments from the Prime Minister, Keir Starmer, didn't seem to endorse Rachel Reeves's position as Finance Minister. That sell-off seemed to be halted after the Prime Minister came out with a statement later offering his full support to Reeves. And the government said that the Finance Minister was upset because of a personal matter. The pound, as you can see there, fell around 1% against the dollar and weakened sharply against the euro. Now, Reeves has in the past often spoken about her commitment to fiscal rules, limiting the amount Britain will borrow, and many analysts saw Wednesday's moves in the markets reflect the uncertainty surrounding her position and whether those fiscal rules would be stuck to. Now, today so far, the gilt market looks like it is stabilising. The yield on the 10-year falling around 10 basis points to stand at around just above 4.5%. And the pound, as we saw earlier, has also recovered somewhat too. But this is certainly a bond market to keep an eye on in the coming days and weeks ahead, and also the currency too. Now, for our call of the day, as that jobs report release is getting closer, we want to look at more of its potential ripple effects. Now, I mentioned earlier that the S&P 500 recently hit record highs. Part of that drive higher has been because of optimism about trade deals being done. But there's also optimism about the Fed cutting rates. Weaker economic data in the past several weeks has pushed the markets to price in 2 rate cuts more confidently. A month ago, it was only pricing in 1 more cut. And if that weaker data stream continues with today's jobs report, then that should further boost rate cut bets. Now, the argument for a weaker number seems pretty logical as well. As well as that weak economic data, there's those immigration policy changes and federal layoffs. Now, here's Nick Timoros from the Wall Street Journal, who helps us unpack all of that.
So a couple things I think about. One is that, the Fed participants this year have been talking they've been talking since last year, really, that they expect the break-even pace of job growth to come down. It went up when we had a huge increase in immigration after the end of the pandemic. It's going down now. The Biden administration did cinch up the border last year, and now the Trump administration is doing much more public raids and deportations, and you're hearing about Hispanic worker absenteeism. And so, there's a report out today from economists at Brookings and AEI who say the break-even pace of job growth could be below 40,000. So you could see, job growth at 50,000 a month and potentially not have the unemployment rate going up. I'm not predicting that, but other people are saying that's possible. And I think the Fed has already taken that on board, that you could see that. It'll feel uncomfortable to see job growth slowing, just as it felt uncomfortable last year to see the unemployment rate creeping up. But it's going to be very hard to gauge underlying labor demand. And then the other point I would make is that it's unusual that you would see the Fed completely change what it's doing on the basis of one report. The big policy pivots that we've seen from the Powell Fed, sometimes it looks like they're doing it on the basis of one report, but it's usually revisions to past month's data. So you get a benchmark revision that says, hey, not only was job growth slower last month, but it was slower for the 6 months before that. You've seen the same thing when inflation data got revised in early 2023, and they sort of toggled from doing 25 basis point hikes to putting a 50 on the table before the SVB collapse. And so it's really just, one report might catch their attention, but what I think has really caught their attention have been a string of releases or revisions that say, hey, the whole trend looks different.
Now, before we go, are you hitting the road this weekend? You may want to know about the price of gas. Yahoo Finance's Ines Ferre has those numbers for you.
Drivers that go to fill up at the pump this holiday weekend will see prices similar to the ones they saw during this time of year back in 2021, 4 years ago. The national average of gasoline is right now at $3.17, according to AAA. A week ago, it was a little higher than that. But take a look. A year ago, it was quite higher than that, more than 20 cents higher than that. And part of this, of course, has to do with oil prices that have been trending lower, even though we've seen some volatility in June. gasoline, one energy expert has told me that you can expect to see some wobbling around in July and also in August. A lot of disparity when it comes to what different states are paying, what the drivers in those different states are paying. California is still the most expensive state for gasoline, with California at $4.58, still lower than last year. But remember that California has a lot of higher taxes and fees because of their green initiatives. They also have an issue, and that's two big refineries that are expected to close. But on average, energy experts are telling us, look, you can expect to see gasoline to trend lower going into the fall and below $3 per gallon on average.
That was Ines Ferre telling us all about gas prices as we head into the holiday weekend. Obviously not affecting those with electric cars, but definitely going to be quite something to think about before we head off to that long weekend. Now, don't forget to stay tuned to Yahoo Finance. We'll have a lot more and reaction to those jobs report. And also stay with us next week as well, because we have some big earnings from some big banks, including JP Morgan Chase as well, to look out for as well. So, as I said, look out for the jobs report later. It's coming out in just over an hour's time. And that's really going to be what the markets will be focused for. And don't forget, it's also a shorter trading day today as well. So the market reaction could be even more severe because there'll be less time to react to those numbers. Well, that's it for us today. Keep an eye on that jobs report, as I've just said, in just over an hour. We'll be covering it here on Yahoo Finance. Also, don't forget, markets close early. Again, I'll repeat that too. So I'll see you at the same time here on Monday. Have a great weekend. And we'll be here on Yahoo Finance for you. I'm Ramzan Karmali, and this is Market Sunrise.